A massive wave of Shiba Inu is flooding into centralized exchanges, and the numbers are absolutely staggering. With $716 million in liquidity now sitting on the sidelines, the entire market is asking one question: is a massive sell-off imminent? Today, we dive deep into the whale movements that are shaking the foundation of the Shiba army. Stay tuned as we uncover the truth behind these shocking exchange reserves. Welcome to Dr. Crypto, your daily serving of Shiba. This is the spot for you if you're curious about anything related to Shiba. If you want to keep informed about all the latest news forecasts and stay ahead of the crypto industry, subscribe. To get more Shib news, be sure to click the like button. Please note that by the time you see this video, some rates may have changed. Financial advice is not included in this video. The current landscape for Shiba Inu has shifted dramatically as we enter the second week of January 2026. The ecosystem has seen expansion through technological upgrades and strategic partnerships, yet the primary focus has now shifted to the flow of tokens between private wallets and centralized trading platforms. Understanding the relationship between exchange reserves and market stability is crucial for any investor navigating the volatile waters of the meme coin sector. Centralized exchanges serve as primary hubs for liquidity, but when reserves reach extreme levels, they often signal a shift in holder sentiment. The sheer scale of the current holdings has created a narrative of uncertainty, pitting institutional accumulation against potential retail exhaustion. As we analyze the $716 million currently held on exchanges, we must look beyond surface-level numbers to understand the mechanics of supply and demand that govern the Shiba Inu ecosystem. According to recent reports, a staggering $716 million worth of Shiba Inu is currently sitting on centralized exchanges. This massive figure has sent shockwaves through the community, as it represents a significant portion of the circulating supply ready to be traded. While this headline number is eye-catching, the underlying reality of the liquidity is far more complex. As per on-chain data, the actual usable liquidity that could be absorbed without causing a catastrophic price collapse is estimated to be much lower, likely between $100 million and $200 million. This discrepancy exists because order books on many exchanges remain relatively thin compared to the total value of the tokens held in reserve. The event has sparked a heated debate among market participants regarding the intent of the holders. Are these tokens being prepared for a massive liquidation, or are they simply being moved to facilitate institutional trading pairs? The timing of this liquidity surge is particularly noteworthy, coming on the heels of a period of consolidation that many hoped would lead to a sustained breakout. The market reaction to this liquidity data has been a mixture of caution and opportunistic trading. The asset is currently trading at approximately 844 units, reflecting a period of intense struggle to maintain upward momentum. While the asset recently enjoyed a 13% price jump, it has since faced significant rejection at key resistance levels. According to market analysts, the presence of such high exchange reserves acts as a psychological barrier for many traders. The fear of a sudden dump has led to a decrease in aggressive buying, with many participants waiting for a clearer signal of accumulation. Trading volume has shown signs of stagnation, with the market cap hovering around $4.99 billion. Despite the underlying tension, there have been brief moments of relief buying as the price touched local support levels. However, these bounces have lacked the volume support necessary to confirm a trend reversal. The sentiment remains fragile, as every minor price increase is met with selling pressure from those looking to exit their positions before any potential large-scale liquidation occurs. On-chain evidence provides a fascinating look into the behavior of the largest Shiba Inu holders. According to data, whale transactions involving Shiba Inu surged by 111% during the first week of January 2026. This massive spike in activity suggests that institutional players are actively reloading their positions, even as retail interest appears to be cooling. Furthermore, the tokenomics of the ecosystem are under significant pressure. While over 7 million tokens were removed from circulation on January 10th, the overall burn rate has since seen a dramatic collapse of over 82% in the following days. This volatility in the burn metric complicates the long-term supply reduction narrative. The concentration of wealth among the top 100 wallets remains high, with significant movements detected between cold storage and exchange-linked addresses. These on-chain signals suggest a tug-of-war between long-term conviction and short-term liquidity needs. The increase in whale trades, combined with the rising exchange reserves, points toward a market that is being professionalized, with larger entities taking control of the price action. Expert commentary suggests that the current situation for Shiba Inu is a classic example of a liquidity trap. While the $716 million in reserves looks like a threat, it also represents a massive pool of potential energy. If the market can absorb the initial sell pressure, a decrease in exchange reserves could trigger a supply shock. However, the technical structure remains bearish in the short term. Shiba Inu is currently trading below its midterm and long-term exponential moving averages, which typically act as heavy resistance during recovery attempts. The potential outcomes are twofold. Either the whales are preparing to exit, leading to a deeper retracement toward the 700-unit level, or they are positioning themselves for a massive institutional push that could clear the path toward 1,000 units. The lack of a clear bullish catalyst makes the latter scenario less likely in the immediate future. The market is essentially in a wait-and-see mode, with the exchange reserves serving as the primary indicator of future direction. The Shiba Inu community, often referred to as the Shiba Army, remains one of the most vocal and active groups in the crypto space. On social media platforms like X and Reddit, the reaction to the $716 million liquidity report has been polarized. Some community members view the whale activity as a sign of institutional validation, arguing that large players wouldn't be moving such significant sums if they didn't see long-term value. Others express concern that the developer's silence on recent burn rate declines is a cause for alarm. Developer hints on Telegram have suggested that new utility-focused projects are in the pipeline, but the lack of concrete details has led to some frustration among long-term holders. Despite the mixed sentiment, the community's ability to rally around the project remains its greatest strength. Hashtags related to Shiba Inu continue to trend, and the grassroots efforts to promote token burns through community-led initiatives are still ongoing. However, the shift from a purely meme-driven narrative to one focused on on-chain data and institutional flows has forced the community to adopt a more analytical approach to their investment. Looking ahead, the short-term forecast for Shiba Inu remains cautious. Over the next month, analysts expect the price to consolidate within a tight range as the market continues to digest the exchange reserve data. A successful break above the 900-unit level would be a significant bullish signal, potentially opening the door for a run toward 1,000 units. However, failure to hold current support could see a slide back towards 750 units. In the long term, the outlook is more optimistic. According to analysts' predictions, Shiba Inu could see significant growth over the next 3 years. By 2029, some analysts project a maximum price of approximately 4,209 units, representing a substantial increase from current levels. This long-term bullishness is predicated on the continued expansion of the Shiba Inu ecosystem and the broader adoption of decentralized finance. While the current liquidity concerns are significant, they may ultimately be viewed as a minor hurdle in the asset's multi-year journey toward becoming a mainstream financial utility. Investors must remain aware of the significant risks associated with Shiba Inu at this juncture. The primary concern is the thinness of the order books. If even a fraction of the $716 million in exchange reserves were to be sold in a short period, the resulting slippage could be devastating for retail holders. Furthermore, the reliance on whale activity means that the price is highly susceptible to the whims of a few large entities. A single whale deciding to exit their position could trigger a cascade of liquidations. There is also the risk of regulatory scrutiny, as meme coins often find themselves in the crosshairs of global financial watchdogs. Neutral insights suggest that while the project has made strides in building utility, it still lacks the fundamental stability of more established cryptocurrencies. The volatility of the burn rate and the uncertainty surrounding institutional intent add layers of complexity that require careful consideration. Diversification and risk management should be the top priorities for anyone exposed to the Shiba Inu market, as the potential for high rewards is balanced by the possibility of significant losses. The Shiba Inu ecosystem is at a critical crossroads, and the $716 million in exchange reserves will undoubtedly dictate the next chapter of this story. Whether this liquidity leads to a massive sell-off or a historic breakout remains to be seen. As always, the Shiba Army must stay vigilant and informed. Thank you for joining us for this deep dive. Make sure to like, subscribe, and keep those diamond hands ready. The day is over now. Remember to give it a big thumbs up. To see our most recent material, share it, and subscribe to the channel.